APAC's asset and wealth management industry recently saw. India's asset management sector reached new heights, Singapore looked to expand the power of its financial regulator, IPOs in Hong Kong hope for a 2024 bounce back, and a boom in ETFs and equity fund launches in China. Let's take a deeper look at these, as well as other headlines and developments. Up to Hong Kong. Following a lackluster 2023, market observers see Hong Kong's IPO market reviving in 2024, with KPMG, Deloitte, and another Big Four firm, each a global network of firms providing accounting and consulting services, forecasting capital raising in the SAR to reach over 100 billion Hong Kong dollars this year. EY, the final firm in the Big Four, estimates it would reach 50 billion Hong Kong dollars before things improve more in 2025. 2023 saw 73 firms listed in the territory, raising an aggregate 46.3 billion Hong Kong dollars over the year. Whilst the majority of estimates see 2024 more than doubling this amount, it is still seen as low compared to prior years. The decline in IPOs was driven by a slump in equities, an exodus of foreign investors, and a tightening of foreign listings for mainland Chinese companies. As rate hikes in the USA end, capital is expected to return to Asia, which will boost market liquidity and improve valuations. The Hong Kong Exchange, the main board of the Fragrant Harbour, has also been busy seeking ways to boost capital market activity, launching a digital platform to reduce the IPO settlement process from 5 days to 2, encouraging fundraising by SPACs, and implementing a listing regime which will make it easier for some technology companies to list. The regime, Chapter 18C, allows qualifying firms with 10 billion Hong Kong dollar valuation and no sales to list, or those with 250 million Hong Kong dollars in sales and a valuation of 6 billion Hong Kong dollars to list as well. Industry observers believe that the move will see 3 to 5 such firms list in the Special Administrative Region via the new regime over 2024. The measures, enacted over the prior 2 years, have not seen much success, with Hong Kong falling to 8th place in IPO rankings in 2023, only 5 SPACs listed in the SAR in 2022, raising an aggregate $639 million, and no SPACs listed in 2023. For SPACs to list in Hong Kong, they must raise at least 1 billion Hong Kong dollars from professional investors and need to acquire a company within 24 months. Such requirements are lower in the USA and in regional rival Singapore. The tech listing regime is also yet to gain traction, with no firms listing via it since launch. Hong Kong Exchange has also gone global, establishing offices in New York and London, and having several roadshows across the Middle East and Southeast Asia over 2023 to attract international listings. Despite this activity, industry observers remain unconvinced, but optimistic that things may improve. The end of 2023 saw over 90 IPOs in the pipeline to launch in 2024, with some seen as being potential blockbuster listings, thought to raise over $1 billion each. Hong Kong's first IPO of the year ended its first day at the price it started the day at, with the wider Hang Seng seeing its worst start to a year since 2005, falling 0.7%. Others see wider efforts to attract wealthy investors to the SAR as stimulating activity in capital markets, namely in the relaunched Immigration Investment Scheme, which, according to officials, has received an overwhelming response. The reformed investment visa sees those who invest 30 million Hong Kong dollars into the stock market or other assets, excluding real estate, granted a faster route to residency. The amount is approximately half that of a similar scheme that regional rival Singapore has. The previous iteration of the scheme saw circa 4,000 annual applicants, and if the revamped version sees similar numbers, they could bring in 120 billion Hong Kong dollars annually to Hong Kong's public and private financial markets. For the bourses of Hong Kong, the fight back up the rankings is just beginning. Moving on, AIMA, an alternative investment management industry association, believes that proposed changes to market sounding risk for hedge funds in the SAR imposes an undue compliance burden on firms and individuals in the Fragrant Harbour, something that may imperil the hedge fund industry in the financial sector. The draft guidelines proposed in October 23 by SFC, Hong Kong Securities and Futures Regulator, apply increased oversight on non-public information sharing between brokers and potential investors. While the move by the regulator is seen as being well-intentioned, it is feared that the implementation would put Hong Kong out of step with other major jurisdictions, disadvantaging those operating in the territory. Hong Kong would be misaligned with other jurisdictions like the EU, Australia, and the UK with regards to the breadth of what constitutes price-sensitive inside information, with those arguing against the proposed framework stating, if adopted in current form, the SAR would lose competitiveness, especially with regards to cross-border transactions, and that the concept was undefined in current or proposed guidelines. It was noted that in the aforementioned jurisdictions, and cited in the SFC document, that restrictions were limited to inside information, something that the SFC believes is hard to define. Further, AIMA notes that the proposed changes fail to take into account the various unlicensed participants in Hong Kong's capital markets, with family offices, offshore investors, wealthy investors, and others cited as examples. The SFC reportedly stated that it was reviewing responses following the close of the consultation period in December 2023. Further, it was noted that brokers and investors were divided on the matter, and those opposed to the expansion of inside information thought that it should be a matter of ethics and morality. The proposed changes come following the collapse of Archegos Capital Management, an event which saw attention drawn to private trading of large blocks of shares, and subsequent probes by US regulators to Morgan Stanley regarding the use and sharing of information by the US financial institutions' employees ahead of block trades, with the proposed changes described as adding extra weights to licensed participants operating in Hong Kong and potentially acting to curb Hong Kong's competitive edge. Whether more changes are seen will be watched with avid interest. So, that is this episode's section on Hong Kong. To see the full video, take a look at the links in the first comment below, or check out our profile for this episode's other sections. Do let us know your thoughts in the comments below, and if there was a topic or development that you think deserved more attention, point it out to us. Thank you all for watching. We hope to see you next time.